Let us continue our discussion of the Fed. From the previous class, the Fed's primary influence is on the money supply and interest rates. Interest is the price paid for the use of money. In the United States, there's actually a huge variety of interest rates. I'm just going to talk about an interest rate in general. Who is this issuer of bonds? We talked about in previous class exactly what a bond is. Well, it just so happens that the United States government is the #1 issuer of government bonds. Why do they do that? It's because they're trying to raise revenue, in this case, voluntarily from the citizens, whether for the purpose of infrastructure, if you believe in that, whether for the purpose of defense, if you believe in that, whether you believe that the national government should help out states who make bad choices, called California, if you believe in that, whether you believe the national government should help out its young people by paying off the debt, if you believe in that, whether you believe that when there's massive unemployment, the government should intervene, if you believe in that. In all cases, all 5 of these things don't come out of nowhere. They require dollars. So one way the U.S. government does that is that it issues bonds. From our previous discussion, we should recognize the relationship between interest rates and bond prices is an inverse one, meaning they move in opposite directions. If an interest rate goes up, bond values go down. Interest rates go down, bond values go up. So it is the Fed that is doing its best to work its way through the recessionary and inflationary phase of the business cycle. Some details of the Fed now. First of all, it is the Fed that runs monetary policy. It is not the federal government / Congress. The Fed runs monetary policy, and they do this through a process of the commercial banking system, which we've discussed sells loans, and loans increase the supply of money. The Fed has 3 tools. They are called open market operations, the reserve ratio, and the discount rate. Let's take a look more closely at #1 and then quickly review #2 and 3. The most important thing you need to know about open market operations is that it is the #1 preferred option of monetary policy by the Fed. It is the buying and selling of government securities. A security is simply a proof of ownership of something that has been assigned a value and may be sold. Both bonds and stocks are simply 2 different types of securities. Anybody can purchase a government bond, but it just so happens that the Fed is the single largest holder of these U.S. government-issued securities. When the Fed purchases securities from commercial banks, it pays by placing newly created reserves in the bank's account at the Fed. I remind you, the Fed is the bank of all the banks. Now let's take a look at the interaction of the Fed and the banks. So, open market operations. Let's say that the Fed buys a $1,000 bond that is owned by some commercial banks. So what happens is that $1,000 the Fed is paying goes directly into excess reserves of a particular commercial bank. Directly, there is no required reserves to be put aside in this particular situation. We've talked about the idea of the monetary multiplier, which we define to be 1 over the reserve ratio. In this case, the reserve ratio is 20%. 1 divided by 20% simply gives me 5. The concept of the monetary multiplier is not a single bank. It is as it ripples through the entire banking system as loans are sold and people come in and borrow more money. So in this particular case, this $1,000, since it's all excess reserves, gets the full monetary multiplier, and in theory, that is how much new money is being created. A different scenario would be, well, what if the Fed decides to buy the bond from the public. Well, in this case, the public has $1,000. It deposits it in the bank. But according to law, the banks must put aside 20% of that $1,000, 200 bucks, into required reserves. So what is left over? Well, it's $800. The excess reserves are the only thing that get the full monetary multiplier, which we already know to be 5. So the bank system, therefore, is increasing the money supply through the process of loans by the excess reserves times a monetary multiplier, which is $4,000. But we must take into account the initial deposit. This is still money that the public has, so that's $1,000. So together, those total to be the exact same result. So if the Fed's goal was $5,000, I guess I have 2 ways of doing it. Quite honestly, this way seems to have a little more players involved, which means that maybe I don't get the desired end that I want. We'll talk about that in a future class. That reserve ratio, it's very important that you do understand the mathematics of the reserve ratio. What we have been working on has been 20%. So one more time, if people deposit $20,000 in commercial banks, 20% of that must be set aside. 20% of $20,000 is $4,000. 20% times 20,000 gives me this. If the banks only actually have 5,000 currently in reserves, and I'm required to have 4,000, that's telling me that I have an excess of 1,000. Any single bank can loan out what it has in excess reserves. It is the monetary multiplier that ripples through the entire banking system. So one more time, be sure you understand there's a difference between what a bank can loan out and the multiplier, which is the entire banking system. 1 divided by 20% is 5. 1,000 times 5 means, in theory, that the money creating potential is $5,000. I would like for you guys to just choose a row, try to work on just one row on your own, see if you can get the mathematics. These would be the correct answers. There we go. Give it a shot. What we want to look at is, well, what's going on when the Fed raises the reserve ratio? I seem to notice the reserve ratio begins to go up. The supply of money via loans begins to go down. And if the Fed lowers the reserve ratio, then it looks like the supply of money begins to go up. Good to know in the future. The discount rate, if you remember, is the price that the Fed charges banks to borrow money from the Fed. If the discount rate is low, it seems that commercial banks would borrow more money, increasing their excess reserves, simply because it's cheaper. If the discount rate was high, then commercial banks would probably borrow less money, thereby not increasing or decreasing their excess reserves, which means the money supply would begin to drop. I remind you, it is the excess reserves that the Fed is targeting. Excess reserves are what banks can use to loan out money, and loans create money out of thin air. Okay.